there. Welcome to Wealthy and Wise for this week. And the question is now a once-in-a-decade opportunity for value investors? Easy question to ask, but perhaps not as easy to answer. So we'll add some value by considering what conditions are in place for equities, and particularly value investors right now. We will then answer some of your stock-specific questions, and we'll answer only with value investing in mind. We'll also get to our viewer question of the week, so hopefully helping you learn something in the meantime. First, though, let's add some value. So today, very simply, we're weighing up whether now is a once-in-a-decade opportunity for value investors, and if so, why? Joining us is Nick Cummings from Intelligent Investor and Andrew Coleman from Teaminvest. Nice to see you both. Welcome to the Ausbiz Studios. So how unusual, if I can just get right into it, Nick, is the current gap between growth stocks and value stocks?
Well, we've never seen anything really like it. You can probably make some comparisons to the dot-com bubble, but that's how far we've got to go back. And so we see this split in the market currently. On one side, you've got sort of the AI trade, and either you're an AI winner or an AI loser. And then you've got a toppy index, particularly the ASX 200. And then on the other side, we have all these companies that forgotten names that are value and quality companies that look really cheap. In some cases, they're trading at GFC-like multiples or even below that. And they've got good balance sheets. They're growing their earnings per share. They're run by sensible people, and they've been completely forgotten to the more attractive and sexy stuff on the other side.
So I don't think you can deny, though, that we have seen, extraordinary performances coming from a handful of mega cap stocks, perhaps maybe even more so overseas than here. In general, do you think success has become too concentrated in equity markets?
I think anytime you see the kind of growth rates that we're seeing at the moment, fueled by cheap money, changes in technology, an increase globally in corruption and circular transactions, that's not oxygen that's being put into the hot air balloon, it's helium, and it's about to go the way of the Hindenburg. So I agree. I think there's incredible opportunities right now in the value sector, because as all of that gas and movement and noise and money is flowing out of boring companies into these, everything is going to be AI, everything is going to be space, everything is going to be success in only a handful of names, it's leaving a hole behind in the valuations of those wonderful companies, which means as a long-term value investor, to Nick's point, what better time to buy, right? When you can buy the same company at discounted prices and get a multiple and earnings yield that we just haven't seen in 20 years. And that's a wonderful time to be a value investor. Potentially a wonderful time if you're on the right side of that Cinderella moment before the music stops and the clock hits midnight. If you're in the AI trade, and it will be catastrophic if you're on the wrong side. So I think as a value investor, we get the joys of letting others dance.
Yeah, but I mean, Nick, are you sort of getting anti-AI vibes around? Like, you don't have to be anti-AI, do you?
No, you don't. And we're not. I think we'll look back on this point in history and think that AI has changed, or ChatGPT, the launch of ChatGPT in 22 was the change of humanity in some respects, similar to how we look back on these other booms in the past, railroads, the internet, iPhone to a degree. So, no, it's not about being anti-AI, but you've got to be realistic. And it's interesting, if you look at both markets, if you look at the Australian market, we think the index as a whole looks a little bit overvalued. It's dominated by the banks, some miners, some supermarkets, where there's not a lot of earnings growth, but that next step down, not the ASX 20, but the 21 to the 200, is now trading at a massive discount despite superior growth rates. That's a little different, though, than the opportunity in the US. In the US, I don't think it's a case of overvaluation at the moment. You can point to certain companies, the SpaceXs of the world, but it's actually probably over earnings. So this huge cycle of AI, the hyperscalers are spending close to $1 trillion, between them. Those dollars have to find earnings somewhere. So they're going to chips, they're going to data centers, they're going to electrician contractors. And some of those companies are trading on 40 times, but some are quite reasonable on 8 times, like a Micron in memory. But how sustainable are those earnings? And I think that's the question. So I don't think it's about being anti-AI. You just have to assess how sustainable these earnings are.
If I could just add to that, I agree. I want to be very clear. I'm pro AI as a technology. I'm anti-bubbles, which is this idea of throwing money at something in the hope that one day it will earn a return when money isn't free. It has a cost of capital. In the end, investors and these companies that are investing are going to need to get a return on the money they've put in order to make their shareholders, us, wealthy. Otherwise, all they're going to do is blow money on vanity projects. And the bit that scares me with what we're seeing globally, some in the ASX, but particularly in America right now, is that question about where are the long-term earnings going to come from, where's the sustainable return going to come from, is being completely ignored with comments of it will come eventually. Field of dreams, build it and they will come. And that might work if you're trying to make a movie about angels. It's tended to be a very bad investment strategy, whether that was the aeroplanes, .com, GFC with financial products, railways, canals, tulips, South Sea bubble, Mississippi bubble. These are the conditions of major global bubbles. When you suspend disbelief and say, the earnings will come one day, just not now.
Okay, before we get back to, I should say, some ASX companies, I do want to get your take then, because it was brought up on SpaceX, Nick. You entitled a piece that you wrote at the beginning of June called SpaceX Heading to Mars, Earth Mugs Wanted. I do like that title.
Okay.
So this was pre-IPO.
Yes.
It's been a massive success, at least in the share price in the first couple of days of trade. So what is your assessment now?
The reason we wrote the article, our assessment hasn't changed. We think that this stock is best avoided. If you want to have a punt, go for it. But this isn't, intelligent investing, how we would put it. You've got a company with a actually probably more now, maybe a $2.2 trillion valuation. Last year it lost $5 billion. It has revenue of around $20 billion. They're selling an AI dream. It's actually their weakest business. It trails ChatGPT in users. It trails Claude in importance. Grok is distributed by Twitter. Twitter's user base is far smaller than a YouTube or a Meta. So it's far behind its competitors in these spaces. And they're selling this at, now a valuation that's worth more than Meta platforms. It's almost worth, or it's getting closer to being the same value as Microsoft. And we just penned this article because we thought this was just absurd. And, I think a lot of people acknowledge that people are buying this as a bit of a speculative punt. They love Elon Musk, and who would have thought Tesla would be still $1.3 trillion valuation? But he sells dreams and he sells them quite well. So that goes back to the title of Earth Mugs Wanted, and you saw that with how they sold the IPO. CommSec, Bell Potter, retail brokers in Australia were getting an IPO of an American company. That is very rare, but this happened around the world. It was European exchanges, or brokers, sorry, Japanese brokers. And it just irked us a bit because you're obviously trying to sell this to them. And then, you had Musk out tweeting before, if you bought Tesla on the day of IPO, this is how much you would be now worth if you, invested $100 or $1,000. And it was just, this goes to explain or show what period of the market we're in, what period of the cycle we're in. But yeah, it has gone well, but best of luck.
Yeah, it's an interesting one, polarizes the market and some of our very own viewers. Look, let's get back though to this whole sort of once in a decade value proposition. So you've said that quality businesses have suffered this once in a decade value decline. But then I have to point out that there are quality businesses such as CSL, but the underlying business has actually been underperforming. So how do you explain that?
Oh, it's a stock specific situation. You're right. There are some businesses that have been underperforming, just like there are some gold miners that are underperforming, but a lot are doing very well right now. You do have to look at each business individually. It's not as simple as buying a basket of quality companies or things that you think are quality companies, because you might find out you have companies in that basket that, like a Cochlear or a CSL, that perhaps aren't as high quality as they once were. So you do have to be, you do have to make calls here, but just broadly, quality companies are trading at, I think it's not a once in a decade, valuation correction. I think it's probably 2 decades. So it's a massive change. And what's interesting is, for the most part, nothing has changed in the earnings profile of these companies. Yes, there are some fears. Okay, so it might be in the healthcare space, it might be GLP-1 drugs. In the software space or the insurance broking space, classified space, it might be AI. There are unknowns and there are fears, but the earnings profiles of these companies are uninterrupted so far. They have a fantastic track record of growing their earnings. They've got clean balance sheets. They're run by sensible people, and they're trading at GFC lows, or in some cases the lowest multiple ever in history, while markets are hitting all-time highs. And I think that is while we see this once in a decade opportunity.
So once in a decade, once in a couple decades in some companies, example, but how long? We've talked about mean reversion. I mean, that can take a long time, couldn't it?
Yeah, history is on average about 18 months. So it depends whether you consider 18 months a long time. For a lot of traders out there, and I call them traders, 18 months is 18 months longer than their holding period. If you're a day trader, it needs to correct in a day, so you won't get mean reversion on your side. But if you're a long-term value investor, and I know that guys at Intelligent Investor are like us, and you're looking 5, 10, 15, 20 years into the future, you can bank on mean reversion. It's just a question of when within that 5-year period or 10-year period. Because if the average is 18 months, it's not going to take 20 years. It might take 2 years, but it's not going to take 20. And I think to that point, Nick's talked about this very well, so I won't add to that. But it was in the beginning of January, I was on with Juliette in one of the very first sessions we did, sort of close of business, of days of trading. And she asked me, what did I think the theme for 2026 would be, which is always a dangerous question because you can guess it in the beginning of January, right?
Nice one, Jules.
But we were, glass of wine in hand, so why not? And I said I thought it was going to be the snapping back towards the mean. And this idea that if you looked at the market at the end of December, it was incredibly bifurcated. You had some companies at the top end trading on ridiculous PEs and price to sales ratios and even price to customer ratios, like back in the dot-com boom. And you had others whose earnings growths were wonderful, trading on ridiculously low PEs as the interest had just left. It's all been sucked into these other names. I think that's started to happen. Some of those mean reversion has occurred, but it hasn't occurred fully yet. We see it in the ASX 50. We were doing that on the show the other week, and you can see in the ASX 50, mean reversion has absolutely occurred. Those drops of 40 to 70% for those high PE stocks in 6 months is unheard of if you want to describe it by anything other than mean reversion. But on the other hand, it hasn't yet happened in the United States, and it hasn't happened in some of the names we'll talk about today. Now, to Nick's point, that's a wonderful opportunity because as a long-term value investor, if you can see a company's earnings growing stably, being achieved with a high degree of return on equity and little or no debt, and you can satisfy yourself that there's no major risk that's actually been triggered. In other words, the share price is not accurately valuing the future because of some big risk that isn't in the past. Well, then what more do you want? On the other hand, if what you're doing is hoping for, orders of magnitude of growth just to justify the current price, that's risky, and that's not where a long-term value investor would play.
All right, so just before we get to some of the companies that you've asked us to put through a value lens, for investors watching today, Nick, is this a moment to follow the crowd or to start looking where others aren't?
I think, as hopefully I've explained, this is absolutely not the time to follow the crowd. So if you're investing locally on, and you want to buy an ETF on the ASX 200, I think the risk there is that index is dominated by 20 businesses where we don't see the capital growth over the next 10 years that you probably have experienced over the last 10 years. So over the last 10 years, the banks were trading on sort of that 10 to 15 times, and now they're upwards of 20 and 30 times, and they haven't grown their earnings, really. So the danger with investing passively, I think, over the next decade is you might have a period where the index doesn't do a lot, but the differences within the constituents of the index are massive. And so we're looking at these other baskets. I think it's a good time to be a stock picker. Obviously, that's bias.
Yeah, that's fair.
But yeah, I think you just got to be careful in what you're doing.
All right. I really enjoyed that adding value. Let's now go and consider some of the stocks you've nominated in head-to-head. All right, so what we did is put out a little call to the ether and asked which companies you would like our guests, Nick Cummings from Intelligent Investor and Andrew Coleman from Teaminvest, to stack up whether they fit the bill right now for a value investor. So if now is a once-in-a-decade opportunity, do any of these companies fit the bill? Let's find out. So welcome back. Nick, I'm going to start with you with the first pick, and this is ResMed. This one's coming from Kathy, and no big surprise, you did mention GLP-1 drugs. That was now a couple years ago where it sent initial shockwaves through ResMed. It's come back and forth, but right now it's really sort of on the nose. Do you think that ResMed is good value?
Absolutely. So it's a buy at the Intelligent Investor. We own it in our funds. Yes, there are concerns about GLP-1 drugs, but as you said, they have been around now for a number of years, and management so far has seen no impact on that business or their sales. The other risk out there is Philips returning to the North American market. That's their largest competitor, and they've been previously, they suffered a recall, and so they're now coming back to the market. And the fear is that they might compete heavily on prices and that ResMed's margins might come under pressure. But we're getting this business for 16 times earnings. It's got a net cash balance sheet. It's been growing its earnings at double digits, and the opportunity here is still massive. So it's a duopoly market structure. ResMed's the leader. There's about 400 to 500 million patients that suffer from moderate to severe sleep apnea, and ResMed so far has a single-digit penetration of that market. So there's a huge opportunity for it. And I think it's pretty rare to find businesses like this with their track record at 16 times earnings.
Shares are down by about 25% so far this year. So would you not wait for the first upgrade to come through in the cycle, or quarterly result that really gets the market to change its opinion?
This is what's very, very hard about this cycle, and really, really hard right now with a business like ResMed. The earnings results have been sensational. If you just open the quarterly and you said, "Oh, what do you think the stock would? How do you think the stock would react?" Knowing that it was on a 16 times earnings, multiple, you'd be like, "Oh, I think this business should be up 10 or 20% over the next week." But it's not. It's down, and part of the reason it's down is not because I think the market doesn't like the result. It's because there's these shiny, sexy things over here that are gathering all the attention. They're going up 100% in a month in some cases, and the money's got to come from somewhere. And so these boring, predictable, resilient businesses are being sold off, despite the earnings growth and despite their results being just fine.
Yeah, I mean, ResMed is a wonderful wealth winner, right? I mean, for 40 years now almost, it has achieved 15 to 20% year-on-year earnings per share growth with an incredibly high degree of stability, return on equity and return on capital north of 20%, no debt to talk about, a $40 billion market cap, trading on a PE of 17, historic 16 going forward. I mean, that's ResMed's earnings and sales per share. That's not a boring company if you're an investor, but it's a boring product. And I think that's, to your point, exactly what's happening. Who wants to be saying around a barbecue, or what fund manager wants to be telling their clients that what I'm investing in right now is a condition that affects mostly older people and makes them snore? That's what we're talking about, right? Sleep apnea gives you heart conditions and snoring. Heart conditions because you're not getting enough oxygen, snoring because that's the sound that gets done because the airways are being blocked. 2 years ago, that was sexy. Everything was all about medical. Now it's not sexy. But that earnings graph, that sales graph is a sexy company if you're an investor. And if you think about it, if you're an investor, you own the business, a piece of the business. What would make it a sexy investment is if they could keep paying me a higher and higher dividend as the business grows and becomes more and more stable and less risky because it's paying off debt and accumulating cash. Well, isn't that exactly what you'd want? And yet, at the moment, the AI trade and semiconductors and you name it is sucking all that liquidity out. Now, that's a problem in inverted commas, as in the share price is down. But if you're a long-term owner, what better time to buy than when the market is ignoring what is a wonderful company? And I think just to that point, if you want to look at the history of its PE ratio over time, if I'll just pull that up, you mentioned, these are once in a decade, once in a 20-year opportunities. This graph, so basically what this is the dark blue graph is the high PE ratio the company traded on in that financial year. The light blue is the low PE ratio. So it's showing you on average the market sentiment. And the line in between is just, the average when you ended each period. Have a look at how low ResMed is now relative to the last 10 years. That tells you that fear or greed of the index. Now, if you could buy, take out the name of the company, any company growing at 20% per annum on a PE of 16 or 17, meaning it's offering you a 6 or 7% yield, growing at 20% per annum from here, with huge upside, because huge addressable market that's not fixed, and a dominant market position, who wouldn't be excited by that trade? But it doesn't have Elon Musk's name and it doesn't say AI.
All right. Okay, let's leave ResMed. I'm going to call that a buy from you, Andrew. Okay, let's get to the next one that's on the list. And I just wonder if our viewer has sent this in before we had a takeover offer, put on the table for Steadfast. Steadfast, SDF, is the next one on the list. Nick, I'll start with you. Value stock?
Look, it has copped a takeover bid, so that makes it a bit hard at the moment. But we kicked off coverage on the insurance broking sector. We didn't cover Steadfast, but we like it and we do own it in some of our funds. But we kicked off coverage on AUB and an American company called Arthur J. Gallagher. And what we saw 3 months ago was really, really rare in the insurance broking sector. The public companies were trading at lower multiples than the private valuations in the sector. So there was transactions being done privately far higher than what you could buy a public company for in that sector. And that rarely happens. It shows you that the sentiment for those companies has been completely thrown out and people are sort of doing irrational things. And so it doesn't surprise me at all that Steadfast copped a bid. And we think AUB, if you do the numbers on what that acquirer is paying for Steadfast, AUB is worth more than $40 a share. It had a takeover offer last year at $45 a share. So we think that's pretty interesting. Obviously, making a call on Steadfast is hard at the moment. You have to consider your tax and all that sort of stuff, opportunity costs and the likelihood that bid goes through. But just the broader point is this sector is cheap. And it's historically cheap and not much has changed.
Yeah, but AUB would sort of be perhaps your preferred pick in
at the moment, yes.
Yeah, okay. Andrew, Steadfast.
Yeah, I mean, the takeover offer's at $6 a share. It's trading at $5.15. So really, that's your merger up. But if you look at it as a company, and if we can just bring this up, I'll just maybe use this as a quick opportunity to explain the screen we'll look at. So this is just the really quick overview screen we have on our Software Conscious Investor. And what it does is across the top, it just basically shows you by a quick traffic light system, where is the company really looking good right now? Where is there a concern? That's the orange. And where are things not so great? That's the red, pretty basic. And what this is really telling us is it's telling us that Steadfast is growing very quickly. You can see down here growing sort of 37%. I think I'll move it up for you. 37% per annum in earnings, 12% in sales. It's doing that with a reasonable level of stability, very high sales stability, low earnings stability. You can see that from the chart. It's a wonderful trend, but 2020 has got a big issue, so you'd have to investigate that. It's doing that with a reasonable return on equity and return on capital, return on equity north of 10%, return on capital a bit under. And the gap there, of course, is because they have a meaningful amount of debt, a 68% debt to equity. Now, that's not super scary, but it's certainly not at the low end either. And currently, if you look at this sort of bottom left side, we have a fear greed index. The market is currently offering you Steadfast shares on a PE of 19.3. That's this bit over here, relative to a normal trading range of between 23.3 and 26.6. So above that is greedy, below that is a ring. So you would look at that as a value investor and you would say, well, look, it's very quick growing. It's obviously quite stable given what it does. It's clipping the ticket on people's insurance contracts. It's got a bit more debt than I would like. Its return on equity and return on capital is okay, but not special. And it's absolutely being currently sold at a discount to its normal history. And then you'd have to make a decision, is that one that's good enough for you? Now, you can see in our case, next to the word Intel at the top here, there is a big zero. That says it's never got good enough for us at Teaminvest. We've never looked at it in the membership to determine if we want to own it. And that's probably because the return on capital is a bit too low and the stability is a bit too low. But having said that, we just talked about these are, boring businesses. A boring business growing at 30% per annum with that degree of chart. Again, you have to ask what's going on in the market other than that sheer excitement crowding people into certain trades and out of others. I'm going to put this one as a hold because of the takeover offer. I can't really say much more than that. But I think it is one worth looking at if you're a value investor.
Yeah, and if you wrote in, thank you. I hope you got something out of that. Let's just quickly get to the next one, and that is ARB. So ARB, I think, has been caught up a little bit in the negativity toward the whole consumer space, rightfully so. It did not have a great result back in February. Of course, we're on the cusp of earnings season now. Is ARB a quality company that has been sold off just because of shiny things over here, or because there are fundamental issues with demand?
I think it's a bit of both. ARB, our analyst Graham, has got a buy on it. So it's been going through this period over the last couple of years. They over-earned in the pandemic. So when people were in lockdown, they didn't go overseas and they spent more on their vehicles, and ARB was a clear beneficiary of that. And that started to flow through their earnings over the last couple of years, and their earnings have fallen, and it's still washing through. Where we're a little bit excited is you can buy this business today at under 20 times earnings. It's historically been a really, really good company, and it's well run. And it's got this US opportunity that we don't think you're really paying much for. And management has been in the US for a while. They've got things wrong. But they're being really patient, and it seems to us that they've just hit the nail on the head recently. They're rolling out these retail stores with an established company over there. The rollout seems to be going well, and they've got actual sales traction for probably the first time in that retail space in the US. So what they're trying to do is replicate the four-wheel drive enthusiast market overseas, and we think there's a chance that they can do that, but you're not really paying for it either. Yes, there is some cyclicality around the auto aftermarket part. There's some risks around, will people put bull bars on EVs and those sorts of things, but for the price you're paying, we think it's a reasonable bet.
So that's a buy from Intelligent Investor. Andrew?
Yeah, I think it's a wonderful company. I mean, it's one we've owned for 20 years, I think, across the portfolio. High degree of stability, reasonable, north of 10% return on equity and return on capital, which for a manufacturer is an achievement. It may not be for a tech company, but in manufacturing with big capital costs, that's obviously something worth doing. A good result, and debt to equity of 6%, which effectively is negligible. And to your point now, and I think why the viewer's writing in, currently available right at the bottom of the green on that PE trading range. Now, what I would say is, always bear in mind that a trading range is a trading range. That doesn't mean it's a good valuation. It just says relative to where it was trading before. And I think to the point that we're seeing with ARB to some extent, people got excited after COVID, seeing the big bump in earnings, and started pricing ARB like a growth company.
Well, they did. It became one of those market darlings.
Absolutely.
Yeah.
I hate those terms, but it's true, right? And it got up to PEs of around 35, 40. Now, paying 35 or 40 times earnings for a manufacturer in an established market sounded always like a way of being disappointed in your ultimate return, because how can a manufacturer with a big capital cost base and retailing base grow at the kind of growth rates you need to justify an earnings multiple that high? And you see that in the earnings. It's not that the earnings for ARB have shrunk or sales have shrunk. It's that they're back on the trend they were in pre-COVID with the spike of COVID. And, markets are full of people. We do wonderful things, but some of us are humans and make really dumb decisions. And there was, I remember on the call, amongst other shows, a big discussion around that 21 to 24 period of, look at that big spike in earnings. It's now 40% up. That's going to continue forever. Why? How? Using a bit of common sense, that was never possible. So, I think ARB is a wonderful company. I think the question now is a PE of 17.6 right for a manufacturer growing on average at about 5-6% per annum? And I'd say it probably is. So to me, it's a hold.
Okay.
But if that price comes down a bit further, it starts to look very attractive again. But paying 35, 40 times for a manufacturer or 1,000 times for a non-profitable explorer always is a dangerous game.
All right. Look, I think we're going to have to go a little bit quicker with these ones, but Dicker Data, DDR, this is an interesting one because it's kind of a little bit AI related, definitely tech.
Yeah. Well, if you asked me 2 months ago, I would have said definitely a buy. They've had a really good update recently. Essentially, what they've done is they've got existing inventory that they bought at lower prices, and now being sold at far higher prices. And they're starting to get the tailwind, as you said, from AI. So every enterprise and small business in the country is essentially making the decision now of, do we upgrade our networking equipment? do we need new hardware? Do we need more endpoint devices? All these things related to AI, and Dicker is one of the biggest benefits of it. I would say it's a hold at the moment, just on the valuation, because it's had quite a run over the last couple of weeks. But it's a terrific business. I mean, it IPO'd in 2011 at 20 cents, and this year it's probably going to pay you 50 cents in dividends. So it's been
That's
fabulous
wonderful.
performance.
Yeah, and it is. To your point, this has kind of flown under my radar just really since the end of May, beginning of June. We've seen this big uptick. So it's up 17% year to date. So is there any value left in Dicker data?
Yeah, I mean, it's now on a PE of 25, which is not stupidly high compared to some of the ones we've been talking about, but it's not cheap either. It's above the long-term market average. And if you pull up the screen, you can see that in the last 4 years, that's now in the greedy period. And, if you compare to long-term market average of 18 to 20, it's clearly higher than that. The concern for me with Dicker, obviously wonderful business in terms of its stability of earnings and its return on equity and return on capital, but it's the Dicker data has grown from the beginning by a strategy of acquisition and debt-fueled acquisition. They've been very successful at it, but remember that IT hardware, and in our private equity business, we own one of their major competitors, so I've got to be a little careful what I say. But in the IT hardware game, stock goes off like in the fruit and veg game. You buy the stock, you're an importer or distributor. If you've got that stock and it moves quick, you make, a nice slim margin, but it's nice, easy money. And if you get it wrong, you can be left with a lot of equipment that has a materially fast declining value. An Apple might go off in 7 days, as in physical to eat. An Apple phone maybe goes off in 7 months, but it's still not years of inventory that you can protect. So having a high debt burden in that kind of environment means you've always got to make the right purchasing decision. Historically, Dicker has. I'm not objecting to that. And if you look at the earnings and sales, you can see that, but it is a risk that we probably wouldn't take. That's probably why we own their competitor. But
Right. That's another story for another time. Okay, and then just quickly, because this one is, I'd call it a micro cap. I don't even think it's a small cap, but Change Financial. So CCA, not Coca-Cola Amatil of days gone by, but Change Financial. Do you know this company? Did you call on your coverage?
I spent 5 minutes on it last night. It's way too small for us and a bit too speculative. We own the giants in the payment space, so Visa and MasterCard, and we've typically found that's where the value usually accrues in the space. That's not to say that this business has no hope. There's plenty of little payments companies that do well. It's just a bit too small and speculative for us.
Very competitive landscape as well.
Yeah, I mean, if you pull it up on our software, you can see it's all reds, right? I mean, at this stage, it's a micro cap. It's not yet profitable. It loses a large proportion of its market cap every year, which means shareholders are being asked to fund future opportunity. That can work. We've just had the 6th largest company in history list on the basis of putting lots of people to fund future losses. But I don't think a market cap of 55 puts it in the same category. And I would say as a value investor, look, maybe one day there'll be something here to talk about. But at the moment with a business that's, sales are growing at a reasonable rate, but earnings have still not broken zero, return on equity a negative 20-odd%. This is not one that a value investor would spend a lot of time on.
Okay, well then we don't have to. But I thought that was a lot of fun. I think we might have to do this again because, of course, we always get stock-specific questions, and that is a segue to this week's edition of Well, Because You Asked. You too can ask us a question, wealthy@ausbiz.com.au. And a regular viewer wrote in saying, Andrew Coleman and yourself, well, I probably didn't say much about it, covered CSL approximately a month ago. Given that the company reported a circa $5 billion pre-tax impairment on the 10th of May, who could forget? Can you tell me if Andrew still holds the same valuation for the company? This is Anthony from Des Moines. Thanks, Anthony. Okay. Do pray tell, CSL.
Short answer, yes. I think if you want to pull up the screen, I can show you the same kind of thing. I think there's always this focus sometimes on the noise, the news, as opposed to the olds. If things are going well, that's olds. Nothing to say here. So we want to focus in the market on the news, the exciting new or scary new things. Now, for anyone who's been following CSL for a long time, it's been pretty clear that they overpaid for Vifor. In fact, we've spoken about this for years on the call since they made the acquisition, and I know, Nick, you have as well, that they overpaid for Vifor. They have now finally admitted that they've overpaid for Vifor. That's not news. That's olds. And yet, it's being treated like this was completely unexpected. Where did that come from? And, how could they have made this mistake? Well, if you're going to penalize them for the mistake, which I think they should have been penalized for, the time to penalize them was 5 years ago when they made the mistake and the price was $300 and something a share and people said they could do no wrong. Not on an earnings multiple of 11 times that's already assuming the sky is falling and treating this like new information. Now, why do I say that? That's CSL's sales and earnings over the last 10 years. That's not the chart of a business that's shrinking or going backwards. You have to make a decision now as an investor, if you're interested in CSL, to do one of three things. Either say this is too hard and I'm going to sit it out, which is perfectly acceptable, or that you think those earnings and sales are going to continue like the past or be materially different. But if you think the cash earnings of the business, so ignore any impairments, the cash earnings, what it generates, is going to continue like the past, then a PE of 11.7 makes this an absolute steal.
That's
the question,
Nick,
mate.
is Andrew just too rusted on loving CSL?
No, I can see it both ways. We've got a hold on the company. We previously had a buy until the last downgrade, I'm pretty sure. It's just been a number of disappointments with that company. One of the big questions or things we didn't like with that, with some of the downgrades has been that they're actually cutting R&D now, and that used to be its moat, was always an innovative company. They always stressed how much they would spend on research and development, and now they're cutting that a little bit, and that signals to us maybe it's been more run for short-term earnings than the long-term earnings, and doesn't have a CEO at the moment. It's got an interim CEO. We think once a new CEO comes in and we can understand the strategy a bit better, that we'll have a better, we'll be able to give you a better answer. You do need to acknowledge too, though, I don't think this is the CSL of old where it was this growing easily in a competitive market, but one that it was completely dominating and double-digit earnings growth each year. I don't think it's that anymore. And when pharmaceutical companies do fall, they are hard to turn around because it does take research and development costs to go into the business, and that spits out a result in 5 or 10 years down the track. So you do need to be careful. In saying all that, 11 times earnings is very cheap for this business, and everyone knows what I just said. It's arguably in the price, and this is where, if you are a value investor, you sort of just have to grit your teeth, close your eyes, and just hit enter and do it. But that's hard to do, and at the moment we're just singing on the sidelines, probably in the too hard basket.
Just on that note, it's an amusing thing, and I agree with you, by the way, everything you've said, but it again just points, I think, that bit of how we oscillate so strongly in our emotions as humans, one way or the other. A few years ago when CSL was on $300 a share plus, everyone wanted to talk about on programs like The Call and other things about how fast CSL was growing. And I remember bucking the trend and being very unpopular by saying, but hang on, if you look at the earnings growth of this business, it's 5 to 6% with a very high degree of stability. So it's a wonderful business, but it's growing at 5 to 6%. It's not growing at 15 to 20. And I kept getting told I didn't know what I was talking about. Now it's still growing at 5 to 6%, and we're talking about it as if it's shrinking. Well, the number still is 5 to 6%. And from that point of view, the question should be, what would you pay for a business growing at 5 to 6% per annum with a high degree of stability? Now, you can do a very quick mathematical calculation. I think that's the one the viewer was referring to that gives you a number, assuming you believe 5 to 6% is right. But that number is not going to be $330 a share, and it's not going to be $105 a share. It's going to be somewhere around that $200 mark, because that's the right kind of PE ratio, sort of around 20, 22 times. That's the kind of true value of CSL. The market, as sentiment does, will oscillate from extreme fear to extreme greed, and eventually we'll find out if we were right or not. Because the real question here is going to be, can CSL continue to grow at 5 to 6? If they grow at 5 to 6% per annum, that's just the same as the past. If they can't, okay, then a change has occurred. But at this point, I'd say there's no real change.
All right. Anthony, you will have to make up your own mind, and I'm not weighing in on CSL. Information only, not financial advice ever from me. All right. I really enjoyed that program, Nick. Thank you so much. Welcome back anytime. From Intelligent Investor, Andrew Coleman. I'll see you soon. From Teaminvest. Thank you both. And thank you for watching. Thank you for sending in your questions. You can do so at wealthy@ausbiz.com.au. We'll see you next week.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.